In 2008, the world's financial system almost stopped working entirely. Like, not just the stock market goes down. We're talking about banks disappearing overnight, millions losing their homes, and the world economy grinding to a halt. And most people think it was just about people buying houses they couldn't afford. But the real story, it's way more insane than that. By the end of this video, you're going to understand exactly what caused one of the biggest economic disasters in history step by step. And most importantly, what you can learn from it so you never get caught in a trap like this. To understand the crash, we have to look at the environment that created it. In the early 2000s, the United States was recovering from two major shocks: the bursting of the dot-com tech bubble and the tragedy of September 11th. The economy was slowing down, and fear was everywhere. So the Federal Reserve, which manages the U.S. economy, decided to step in. They came up with a plan. They started lowering rates, make it cheaper for businesses and regular people to borrow money. Because when interest rates drop, the cost of loans and debt goes way down. In 2000, the rate was sitting around 6.5%. They started cutting and cutting and cutting. By mid-2003, they'd brought it all the way down to just 1%. The goal was to encourage people and businesses to borrow and spend money to jumpstart the economy. And honestly, it worked. The economy started recovering. Businesses started hiring again. But this is where things started to shift in a dangerous direction. With interest rates at historic lows, borrowing money became incredibly cheap. And when money is cheap, people borrow. A lot, especially for big purchases. And what's the biggest purchase most people make in their lives? It's a house. For most of us, a house is the single biggest thing we'll ever buy. And to buy one, you almost always need a mortgage. A mortgage is basically a loan you take out to buy a house. You pay it back over time. Usually 15 to 30 years with interest. The lower the interest rate, the lower your monthly payment. So when rates dropped to 1%, getting a mortgage became way more affordable than it had been in years. Suddenly, people who'd been renting or living with family thought, wait, I can actually afford to buy a house now? At the same time, the government was pushing hard to increase home ownership rates across America. They put significant pressure on government-sponsored mortgage giants like Fannie Mae and Freddie Mac to make mortgages more accessible to lower-income Americans. The intention was good. They wanted everyone to achieve the American dream. But this pressure encouraged lenders to relax their strict safety standards. With cheap money and government encouragement, the housing market started to boom. Millions of Americans bought homes, and prices started climbing. But by 2003, the banks faced a new problem. They were running out of qualified customers. Traditionally, banks only lent to prime borrowers. These were people with steady jobs, high credit scores, and cash for a down payment. But eventually, everyone who fit that description already had a mortgage. And by 2003 and 2004, there was so much competition between banks to hand out loans. If the banks wanted to keep their profits growing, they needed to find a new source of borrowers. So, this is when they started lowering their standards. A lot. They created something called subprime mortgages. Subprime basically means lending to people who don't have great credit or stable income. And we're not talking about slightly risky borrowers. We're talking about people with bad credit scores, inconsistent job history, or very little savings. Some banks even offered what they called ninja loans. No income, no job, no assets. Yes, that was a real thing. You could get a massive loan to buy a house without proving you had any way to pay it back. You might think, why would banks do something so risky? Well, this is where it gets interesting. Normally, when a bank gives you a mortgage, they hold on to that loan. You pay them back every month for 30 years. So if you stop paying, the bank loses money. That risk keeps them cautious about who they lend to. But banks figured out a way around this. They could package up thousands of mortgages, including all those risky ones, and sell them as a product. These packages were called mortgage-backed securities, or MBS. When the bank sells MBS, they get their money back immediately. They make a profit from the sale. And now the risk of those borrowers not paying, that's someone else's problem. The bank doesn't care anymore. They got paid. So, who was buying all these risky MBS? This is where Wall Street enters the picture. By 2004, big investment banks like Lehman Brothers, Bear Stearns, and Merrill Lynch started buying up these mortgage-backed securities in huge quantities. But here's the crazy part. The regulator actually let them go wild because the investment banks weren't just buying these MBS with their own money. They were buying them with borrowed money. In 2004, the SEC Securities and Exchange Commission changed a rule that used to limit how much these big banks could borrow and gamble with. They said investment banks with over $5 billion in assets could borrow and leverage as much as they wanted, no limits. So with the new rules, for every $1 the bank actually owned, they were borrowing up to $30 to buy more of these mortgage bonds. They were betting the entire house on the belief that home prices would never fall. And regulators trusted that Wall Street experts were smart. They can manage their own risk. But this assumption was a major blunder. So armed with billions in borrowed cash, the investment bank didn't just sit on these loans. They got creative. Imagine taking a bunch of questionable loans like mortgage, credit card debt, car loans, corporate loans, mixing them together with some decent ones, and packaging them into a box called a CDO, or collateralized debt obligations. Then they took slices of that box and repackaging them again. It was like a financial layer cake, and every layer made it harder to see what was actually inside. Now, you'd think investors would be skeptical, but there was one thing that made everyone feel safe. It's the ratings. There are companies called credit rating agencies whose whole job is to grade investments. If something is super safe, it gets a top rating, AAA. And if it's risky, it gets a lower grade. And guess what rating these agencies gave to the CDO packed with subprime mortgages? AAA, the highest possible rating. But why do they want to give AAA ratings? It's because conflict of interest. The rating agencies were paid by the banks that created the CDOs. If they gave a bad rating, the bank would just go to a competitor. So, to keep the business, they stamped AAA ratings on these toxic bundles of debt, even when the loans inside were absolute garbage. So investors looked at these AAA ratings and thought, this is safe. Pension funds, retirement accounts, insurance companies, they all bought in. The whole world was betting on these mortgage securities, and almost nobody realized they were built on quicksand. So this entire machine, from cheap loans to complex CDOs, created a massive feedback loop. It pushed home prices higher, making it look like the market could only go up. In some cities like Las Vegas, Phoenix, and Miami, home values doubled in just a few years. And as long as home values kept rising, even if someone couldn't pay their mortgage, the bank could foreclose, meaning the lender takes back the house if you stop making payments, and they will sell it at a profit. That made everyone feel safe. But underneath all that optimism, cracks were starting to form. Remember those subprime borrowers? The ones with shaky finances who got loans they could barely afford? A lot of them had what's called ARM, or adjustable rate mortgage. These loans started with a low interest rate for the first couple of years. It made the monthly payments affordable at first, but then the rate would adjust upward. Sometimes it would double or triple. For a lot of people, that was impossible to pay if their mortgage doubled or tripled. They couldn't make the payments, so they started defaulting. By late 2006, foreclosures kept climbing. As more people defaulted, banks tried to sell those homes, but soon there were way too many houses on the market and not enough buyers. And when supply increases, but demand starts slowing down, prices stop rising. In some areas, they started falling. This is where the whole system hit its breaking point. As home prices dropped, the value of all those MBS and CDO dropped too. Suddenly, the smart-sounding investments in people's retirement funds, bank balance sheets, and even foreign pension plans were filled with failing loans. Banks realized too late. Nobody wanted to buy their toxic assets. Trust between financial institutions evaporated. Banks stopped lending to each other because they were afraid the other bank wouldn't survive the night. Panic spread quick. The credit markets, which are the plumbing of the global economy, froze completely. And then came 2008, the year everything fell apart. Bear Stearns, one of the most respected investment banks, collapsed and was bought out for pennies. In September, Lehman Brothers, one of the biggest investment banks in the world, with over $600 billion in assets, went bankrupt. Other massive banks started failing. The stock market went into a nosedive. The Dow Jones dropped over 500 points in a single day. Banks around the world started failing or teetering on the edge. Businesses couldn't get loans to pay their workers. It felt like the entire economy was about to collapse. AIG, one of the largest insurance companies in the world, had sold billions of dollars worth of credit default swaps, which were basically insurance policies on those MBS. When everything went bad, AIG owed hundreds of billions they didn't have. The government stepped in with an $85 billion bailout. Why? Because if AIG collapsed, it would have dragged down every major financial institution with it. The risk was too big to let it fail. So, the U.S. government jumped in with multi-billion-dollar bailouts to keep more dominoes from falling. They poured $700 billion into a rescue plan called TARP, the Troubled Asset Relief Program. The Federal Reserve dropped interest rates to near zero and started pumping cash into the system however they could. In the United States alone, 8.7 million people lost their jobs. Unemployment shot up from around 5% in 2007 to 10% by 2009. Nearly 4 million families lost their homes to foreclosure. Housing prices dropped more than 30% on average. Some neighborhoods were hit even harder, and more than $11 trillion in household wealth just vanished. But most of the big banks survived because they were bailed out with taxpayer money. The government saved them. Meanwhile, the millions of regular people who lost their jobs, their homes, their savings, they got almost nothing. That disparity caused enormous anger. It led to movements like Occupy Wall Street and a deep distrust of the financial system that still exists today. After the crisis, there were reforms. In 2010, the Dodd-Frank Act was passed to regulate banks more strictly. It required stress tests, higher capital reserves, and limits on risky trading. But even some of those rules have been weakened or rolled back in recent years. So that's the full story of how it happened. But what does this mean for you? There are real practical things you can take from this. First, always be skeptical when someone promises easy gains on borrowed money. If you need debt to pull off an investment, you need to make sure you've got real backup, not just hope that prices rise forever. Second, remember, every system looks unstoppable, right up until it cracks. In the 2000s, it felt like housing prices couldn't fall, but history is full of times where everyone was wrong. Make decisions based on your own research and needs, not just fear of missing out. Third, never forget how important liquidity is. That means enough cash or assets you can quickly access in case things don't go as expected. History doesn't repeat exactly, but it does rhyme. Another crisis will come, but the lessons stay the same. Don't let greed or fear make your decisions for you. Subscribe, and I'll see you in the next one.